Hello, everyone. My guest today is Will Hayes. He joined LucidWorks in 2013 as the Chief Product Officer and was appointed CEO in 2014. He has over 15 years of product marketing and business development experience. Before this company, LucidWorks, he was head of technical business development at Splunk, where he was responsible for defining the company's market category and key product feature sets. All right, Will, you ready to take us to the top?
Sure thing.
Okay, so for the rare human that has not heard of LucidWorks, tell us what the company does and what's the revenue model. Are you guys pure play SaaS?
Sure. We are actually hybrid. We deploy our technology on-prem. And when I talk a little bit about the use cases, that would make sense given the sensitivity of data that we work with. We also have SaaS offerings that we target primarily towards retail. LucidWorks at its core is that we've built a search engine that combines the power of search along with machine learning and AI to really create personal experiences around data. Our viewpoint is that really in this day and age, the only experience that matters, the only user experience is the data experience. And so customers deploy our technology to help online shopping, customer support behind the firewall. We're helping support agents and researchers find information quickly. And we really personalize that information both for the workplace and for digital shopping.
So be specific here for a second. I know you work with Staples, right? So how does Staples use you guys?
Yeah, so on their business platform, when you're buying in bulk as a company like LucidWorks as a customer of Staples, so if I'm purchasing office supplies, equipment, be it large physical goods like printers or having to go refill cartridges and paper and all the things that we use in and around the office, they're using our technology to power the search and the browsing experience along with product discovery and merchandising, and so helping you learn about new services, new products in relation to the preferences and behaviors that you've shown in the past.
So they're connecting essentially all the metadata related to all their product features, the pictures, the images, all that jazz. And then are you doing anything that enables Staples to know, oh, it's Will viewing staples.com right now. Let's show him this toilet paper that he really likes. He likes the 5-ply.
Exactly. So because if you think about kind of where the search engine sits and that whole kind of interaction, we are actually capturing all the user intent. We're monitoring their behavior when they look for something, when they click on something, add it to the cart, check out. And so we're processing all of those signals that we're capturing, and we're using that to build personalization models. And so we know it may be that, these are the preferences for Will, or it may be that, Will bought printer cartridges 6 weeks ago, and we know there's a propensity to refill every 6 weeks. So let's promote that item to Will, both on the site, in a mobile application, or maybe we even send that inside out through an email promotion.
Interesting.
So we're monitoring and capturing, really it's the telemetry data, right? All the data that's sort of surrounding the interaction. Some of our customers, for instance, will go down to the point of like, how long did you mouse over a certain item before you clicked on it or before you scrolled past it? We can take all those signals and make sense of those signals through machine learning and use them to find better precision and personalization and targeting of content to users.
And then help me understand a revenue mix. So over the past 12 months, if you look at your total revenue, what % would you categorize as pure SaaS versus something else?
Sure. So there's been a huge shift in that we launched our SaaS product last year. So as my CFO and I like to say every quarter, we're growing by about 1,000%.
I was going to say, it's easy to go from $1 to $1,000. And
it really is. And then from 1,000 to 100,000.
Yeah. You lead every board deck starts that way, right?
Runaway growth, of course. It's wildly successful, but no, what's interesting is really, that mix has caught up, and so we're at about 25% today. We think we're going to be over 50 by the end of the year. When you look at our two solutions, right, one for the digital workplace, helping kind of personalize content for employees in large organizations like Morgan Stanley and other kind of global organizations, they still do a lot on-prem. So that's why we still support the on-prem software as much as it's a pain in the ass, and we've got to worry about hardware provisioning and networking and all that.
Will, is there still kind of the SLA though agreement there? It actually still is recurring revenue. It's just not like your traditional SaaS.
Absolutely. And so, as the Valley has done over the last few years, we run everything like a SaaS business. Even our on-prem business is subscriptions, annual licenses, health checks, customer success models, all of those things. It just so happens where the deployment is behind their firewall.
So what, and obviously don't be offended by this, but what took you guys so long to launch a SaaS product? Most people that had a strong on-prem presence were getting into SaaS back in like 2010, 2011-ish.
Yeah, in our space, both the volume of data that we deal with and the sensitivity. We do a lot of healthcare, a lot of financial services. These are sort of the late majority when it comes to adopting technologies like cloud. Most of them are just now starting public cloud initiatives. And so the focus of our go-to-market was both around sort of highly complex organizations with massive amounts of information that they needed to surface and personalize, and highly sensitive information. So again, healthcare, financial services, telco. It is changing. And in fact, a year ago, you couldn't even mention the word cloud inside of a bank. Literally, you'd be thrown out.
Yep.
Now, most banks that we're engaged with are starting pilots with various public cloud providers, private clouds. And so the world is shifting. So for us, it was really about just timing the market correctly. We wanted to go through a bit of a microservices re-architecture before we truly launched a SaaS platform. So we waited a year when other folks in our space were kind of starting to get there. But now we're full steam ahead, and we're even seeing the more legacy use cases and the legacy kind of industries, if you will, are starting that sort of late majority adoption of things like public cloud and SaaS tools. And so, it's sort of aligning perfectly with our roadmap.
So moving forward for the rest of this, I'd love to just focus on the cohort, right? The SaaS cohort that you guys are working on. And so with that in mind, give me a general sense of what you're targeting here. What's your sweet spot in terms of what the average customer is paying per year to use the tech, would you say?
Yeah, good question. I mean, we typically target kind of the global 2000. So we're not interested in like putting, like there's these little products like Algolia or something like that, where you're going to stick something on a web page and surf through 100 pages or, every tiny site out there or TechCrunch or whatever. For us, what we're looking for is more multidimensional. And so, customers of ours who have worldwide deployments of content in multiple languages, multiple geographies, multiple GDPR requirements are definitely kind of right there in our sweet spot. So our typical order size is, between kind of 250 to 500,000 on the average, with, multiple customers well into the seven figures. And these are annual licenses using that SaaS model.
I mean, so would you say, is it fair and accurate to say it's really difficult to get started with the LucidWorks products unless it's at least $250,000 kind of ACV?
To be honest, like if you have a smaller order of problem, there are other vendors that we might refer you to, right? It really depends on not exactly where you are today, but what is the roadmap of all the problems that you're trying to solve. If you're saying, look, I've got a simple search problem on a simple site, want to check this box and move on to other things, then yeah, there's products like Algolia and SwiftType that we think do great. When you're looking at large government deployments, large global enterprises, even if we're biting off that small piece, like we'll do transactions that, typically not below like a 48K, but somewhere in that range. It's really looking out to the roadmap of where do we kind of go from here and how do we partner together? And that's where we're most interested in getting engaged. We want to, build meaningful relationships. We're not just in here to transact and leave.
Put this on a timeline. I know you took over kind of 2014, but when was the company launched? What year?
Company was launched in 2008 on a completely different business model.
Hell of a year, by the way, to launch a company.
Oh, it was. They learned.
Yes. Now, and you guys have capitalized yourself. So what's the updated number? How much have you raised to date?
Yeah. So let's see. From the time that I've come in, I'm just kind of doing quick back of the math.
Sure.
I think we've raised about 60 million. At the time, the company was founded actually as an open source support and services company, entirely different model. I was sort of brought in as part of the transition to this new model. And so we had recapped the company and, kind of restructured everything as part of that transition.
Wait, sorry, who you're talking in 2012, the recap? The private equity round?
Yeah, no, I think that was before me. I'm talking about when I took over. We did a recap around 2015.
Well, I guess what I'm asking there, what do you mean by recap? You had a private equity firm come in and buy up a bunch of early shareholders, or
no, still venture back. Just that because of the transition and the pivot of the company, we were effectively restarting the company, and so you go through a process in which you have to kind of even things out. Obviously, as I come in and I'm recruiting new teams and rebuilding, we want to have a preferred stack, which is nice and small, and just getting the company sort of right sized.
Yeah, Will, sorry, you're talking about like a pivot, not a financial recap of the cap table.
Well, it would include, kind of recapitalizing on the cap table as well.
Okay. Well, I guess that's what I'm asking you about then, right? So you did the $50 million round in 2018, and then in 2016, you had a little debt financing. In 2015, there was a $20 million round with Allegis. Which one of those would you consider the recap?
The $20 million round.
Oh, I see. Okay, got it. The Series D.
The Series D. Yeah. So that kind of brought us back to a Series B on paper.
I see. In terms of how much, like the percent of the company that investors owned?
Investors own, preference stacks, anti-dilution,
liquidation preferences,
all that kind of stuff. Yeah. That's the recap that I'm talking about. And again, that put us in a position to grow the company from where we were then to, today where, we're well on our way to $1 billion valuation.
Yeah. What do you think you have to get ARR to actually hit $1 billion valuation?
I don't. Well, I mean,
Maybe not you specifically. Maybe in general.
Sustained growth, right? I mean, the value in companies like ours is going to come from the growth rate, not just the actual ARR. I'd say, in the case of kind of, you can look at comps out there in the market. There's people going 20x forward. There's people going 5x current. For us, we're looking around. Where do we go from last year to this year to $100 million in revenue and beyond? We believe that we're about, I'd say, 18 months away from that sort of milestone, if you will.
Yep.
We've got some pretty exciting news that you'll hear about here pretty soon as well.
So just to be clear, Will, you think you'll break the $100 million mark sometime next year in terms of run rate?
Next year, yeah. I mean, I would say in the next 18, yeah. So next calendar year, definitely. Yeah. We're only in July.
That's great. That's good. So when you come in and take over as as obviously leader, you're setting strategic goals every year. So in order to hit kind of that milestone, the next, call it 18 months, I mean, are you guys? It's obviously hard to grow a company when you get bigger and bigger numbers. So are you targeting kind of the 20-30% year-over-year growth rate or something higher?
Much higher. Yeah. We're, we've been in triple digit growth over the last 4 years. Obviously that doesn't sustain forever, but we're staying well north of 50%.
Okay.
Sure.
So when you say triple digit, I mean, over the past 12 months, you're saying you grew the company about 50% in terms of run rate?
100%.
Okay. That's what I thought. That's why I said triple digit would be 100, not 50. So 100% year over year growth north of that. And you hope to sustain it.
We've done 100% for 4 years in a row. That's not, I'm not going back to my investors and my board and saying, expect this to last forever.
Of course.
But, as we start to optimize around, it's not just, again, top line, but we're looking at margins. We're looking at sort of the health of the mix of the revenue, the CAC. There's a lot of metrics that we start to optimize for as we get to this stage.
Yeah. So help me understand right now, again, we'll just talk about the SaaS portion of the business, right? How many folks do you now have customers on just the SaaS portion of the business?
That's a good question. Again, just
like hundreds or dozens?
Numbers. No, we're still in the dozens. I mean, we're about 400 customers total. And so, on the newly launched SaaS platform, we're probably reaching like 50. If I don't have the data in front of me, but just anecdotally, I could confidently say 50.
Yeah, no, that's good. I mean, 50 folks at the $250,000 kind of ACV would put you at a $12 million a year, and if that's 25% of the total business, right, that would mean you're doing, call it $50 million run rate overall or something like that.
Pretty good at math.
Yeah, that's quick, right? And then you said about a year ago you were half that.
Yeah.
Did most of that growth come from expansion, or is it really just the success of the SaaS product launch?
We're really seeing a lot more in sort of new logo acquisition. I mean, expansion is an important part of our business, but as we've grown and kind of grown our profile, as we get more referenceability, we're seeing a lot more. We've been declared now leaders in Gartner and Forrester, and so all of that stuff is kind of creating more awareness. Launching global offices, we just turned on Hong Kong. We've been in the UK for about a year now, so all of these things are contributive to growth and to overall the success that we've been seeing over the last few years.
How aggressive? I mean, look, companies at this scale. So I've had maybe 50 CEOs on that are scaling, call it doing between 40 and 120 million bucks in ARR. And they all have kind of different, most important metrics. And so like one of them is salesperson productivity, right? Is it a 5x output profitability wise or 7x or 10x? What are you optimizing for there? Do you know?
At the top of my head, I'm spending a lot more time in what we're building and how we're taking it to market, and then those metrics. I mean, sales.
But isn't that critical? Isn't that critical? That is take to market.
Is critical. I think what I looked at productivity more for is the impact of both how we're enabling, which ties back into the way we're positioning and telling our story, and then the capabilities within the product, which are really about accelerating the time to value, that kind of aha moment, right? And so we watch closely who's getting productive, who's getting ramped, how much time it's taking. We do a lot of cohort analysis to try to understand why certain cohorts tend to do better and quicker, while others take a little bit longer. We take a very thoughtful approach. I've had to make changes with people that were hitting numbers and exceeding numbers because they just weren't quite doing it the way that we'd like. We've kept people around that weren't quite, making it yet because they're doing all the right things, and we like the foundation, and it's taken them longer to kind of get things turned on. And so, there's no simple answer to, you can't just look at a spreadsheet and determine who's performing and who's not. There's a lot of detail that goes behind it. As the health of the business is concerned, obviously, as we bring in more capacity, we look at a ramp time, we look at an expected sort of attainment amount, and, we model the business around that attainment. And so, again, if we're dropping below, I believe like we put 80% into plan. If we were seeing that across the board come below, we'd have an issue.
Sorry, I don't know what that means. What do you mean 80% into plan?
You set your sales rep productivity
Quota attainment.
and quota attainment in your model, right? Obviously, I don't want to spend cash assuming that every single sales rep is going to seed 100%.
Yeah, I guess what I'm trying to figure out is if a salesperson, if they hit their full quota, right? Let's say their total company year is 200 grand. Are you generally setting that like 5x or 10x, right? So that ratios, again, I'm just curious how you're modeling profitability.
Sorry. So, okay. Yeah. I'd say we're roughly in the 5-ish.
Okay. Yeah. That's what I've heard from others. So yeah. So, I mean, the reason I'm asking is I'm trying to get a sense of how aggressive you're being with CAC. Obviously, salesperson salary is a critical piece of that. But in order to get a $250,000 account, will you spend all that money up front to get them for a year-long payback?
Not all of it. No. In fact, I mean, we have a pretty efficient sales cycle. I mean, we're selling use cases that people know they need, and the ROI is clear, right? If I can help you increase your add to order value, if I can help you increase your revenue per visit through better discovery and placement of product and services and things that people are going to add to their carts and transact with, it's a pretty straightforward sales cycle.
So, right? But what do you optimize then for CAC? 6 months then, it sounds like, lower?
For the payback, I don't know the number off the top of my head. It's really, I mean, I've got an entire operational side of this business that is going to give you more precise answers. I feel like I'm raising money right now, dude.
No. I mean, the reason I'm asking is because some people would say in this space, whoever can spend the most money to get the customer will win the customer, right? So whoever has the healthiest economics ultimately wins. And so that's what I'm trying to understand is how aggressive you're being there.
Yeah. Again, I mean, we're very disciplined in our models in terms of how we manage, both cash and the business and expectations at the top line. How we put precise numbers on the CAC payback, that's just not an area that I'm completely engrossed in.
Mm-hmm. That's fine.
Yeah. It's an interesting, as you see the contrast between the way different companies look at it. What we're not doing is we're not.
Well, I mean, by the way, Will, just to be clear, any company that's raised $50 million has a CAC target payback period. Like it is in the deck when you raise from the Series E investors. Like it's a key thing, right? So most people, when they raise that amount of money, they're comfortable stretching payback into the 18, 24 month range versus staying conservative in the 12-month range. And what you just told me is you're less than 12 months. So that's what I'm trying to understand is you have essentially figured out a way to get customers, high value customers at way cheaper than what most people would at your stage.
I'll take that from your perspective as a compliment. But again, when we're looking at the overall health of the business, we're just trying to determine exactly what it takes to acquire a customer, grow a customer, time the next deal, and again, optimize for that kind of TCV, if you will.
Yeah.
But again, it sounds like you have a great contrast to kind of compare what we're doing to.
Well, yeah, maybe. But getting back to kind of what you're good at, which is product. I mean, you're a product guy at heart. Help me understand how you've structured pricing to drive upsell revenue. So are you upselling based off feature upsells, or is it a utility-based upsell on a value metric, or seat-based?
Really great question. So when you think about kind of the sort of the data platform that we provide, it's a combination of obviously the overall size of the corpus. So how much processing, compute, and storage do we need to manage in order to serve up this data? And then the enrichment, which are really kind of CPU cycles around machine learning. And so typically, if I had a picture, I'd show you a grid with the X and the Y that, we can start to grow data volume, and that will lead to some sort of upsell. And that tends to be mechanical, right? They roll out 5 nodes. Now they're at 10 nodes. Now they've added a whole new data source. Thing is growing. It's pretty, I don't say predictable, but the customer kind of can understand kind of where that growth sort of occurs. Where things start to get interesting is as you start to add along the dimensions of machine learning and you start to increase features and operations that way, that can also kind of increase the overall kind of bill of material, if you will. And so, we're looking for applications and use cases in which where we can grow both, obviously, right? Now, with that, vertical line comes value. Right. So as you're adding more of the machine learning and the discovery and the AI capabilities, the ROI will increase over time, just because those are the things that are helping drive some of those conversions and drive some of that precision. And
are people sticking? I mean, are these product upsells enabling people to get more use out of it? What does churn look like and how to keep it low?
I mean, we are 130% net retention. I'd
What's
say
that onion look like though underneath?
When you say that onion, sorry.
So 130 would be made up from expansion revenue subtracted from any gross revenue churn. So you have at least 30% expansion. Do you have no gross revenue churn annually?
No. That's what I was just about to say. And so we're at about 93%.
Oh, okay.
Actual retention. So no, I know if there's a metric that I actually know. So we're best in class in that.
No, I'm just curious. Okay, good. Yeah, 7% churn, 37% expansion will put you at 130 net. I mean, that is a great number. I would say world-class net revenue retention is 140. So so that's a really nice number there. Let's wrap up here real quick with team size. How many folks?
So we're about 250 right now.
All in California, you guys spread out?
No, we're pretty spread out. So we've got, about 100 folks here in San Francisco and headquarters. We've got another headquarter kind of out for the East Coast in Raleigh that's probably got about 30 folks. Our engineering team's pretty distributed, kind of back to our open source roots. We'll hire the best people wherever we can find them. And then we've opened up, again, UK and Asia Pacific out of Hong Kong. With about another kind of 15 or so folks respectively in each office. And so, we've not kind of gone nuts with growth, but we're definitely trying to keep up with the demand, particularly on the go-to-market side. R&D, we're always finding areas to make new investments, but we're not looking to like triple the size of our engineering org just because we have cash or whatever that might be. We want to really just respond to where we think the market is showing, needs and where we think we can come in and be successful on behalf of the customer.
That last raise was over a year ago. Usually the kind of VC kind of companies like this raise once a year. Are you raising now or are you good to go?
We'll see.
All right, let's wrap up with the famous five. Number one, what's your favorite business book?
Favorite business book, 3 Laws of Performance.
Number two, is there a CEO you're following or studying?
Anyone I can get content from.
Pick one.
Admire people like Tony Hsieh. I think is probably one of my favorite guys out there.
Number three, what's your favorite online tool for building LucidWorks?
For building LucidWorks, Trello.
Just the company, yeah. Okay. Number four, how many hours of sleep do you get every night?
Not enough.
What would you say, 4, 5, 6?
I'd say 5 to 6.
Okay. And how old are you?
I'm 38.
Married, single, kiddos?
Married with a 2-year-old.
Social security number? No, just kidding. Right. Last question. What do you wish your 20-year-old self knew?
Oh, man, just be curious. That's all you have to do. Just ask a ton of fucking questions.
Guys, Will Hayes, LucidWorks, be curious. They are now serving, call it 400 customers. About, call it 50, 60 of those are on their SaaS product, which now makes up 25% of their total revenue mix. Hoping to break, call it $100 million in ARR over the next 18 months or so, historically growing about 100% year over year. These customers, again, paying, contract values well into the 6 figures as they look to scale with their team of 250 people. Again, SaaS product helping these companies with AI-powered search, folks like Staples.com to give customized experiences to folks shopping. Will, thanks for taking us to the top.
Appreciate it. Thanks a lot.